In 2011, I took almost all of my savings and bought gold the moment I heard the first news of an economic crisis. It was a decision that gave me the ultimate sense of safety at the time. And it was a decision that cost me the next 5 years just to break even. Today, in 2026, when I look at the lines of people waiting outside gold exchanges, I know history is repeating itself. Let me ask you something. If you woke up this morning and saw the price of gold drop 20%, what is your first reaction? Do you breathe a sigh of relief because you haven't bought in? Or do you panic because you moved all your savings into it? Most of the people in those lines think they are buying a safe haven, but what they are actually buying is an illusion of control and paying a very high price for it. That's what this video is about. Not the metal itself, but what a financial panic quietly takes from you while you aren't looking. There's a version of financial protection that actually traps your money. It doesn't look like a mistake, it looks like the most popular news story of 2026. When an asset gets this loud, it usually stops being a safe haven and starts becoming something else entirely. And the reason most people get caught is because buying it genuinely does feel like a win at first. Let's start with the history of crowds. There's a moment in every economic cycle that I remember reading about and then living through. The headlines get scary. Inflation or recession is all anyone talks about. And suddenly, buying gold feels like the only responsible thing to do. Here's the quiet part most people miss. The average retail investor rarely buys an asset when it is quiet and cheap. They buy it when they are scared. Look back at the year 1980. The economic fear was intense. People panicked and flooded the gold market, driving the price to a historic peak. It felt incredibly safe at the time. But if you bought gold at that exact peak, it took you nearly 3 decades just to break even on the numbers, and even longer if you adjust for inflation. Almost 30 years of waiting just to get back to zero. You're not buying a productive company, you're buying a piece of metal that produces nothing, pays no dividend, and simply sits there, waiting for someone else to be more afraid tomorrow than you were today. The exact same cycle repeated in 2011. The crowd rushed in, the price spiked, and then it quietly bled out over the next 5 years. History shows us that buying what is loudest is almost always the most expensive way to feel safe. The rush to buy physical assets carries a psychological weight most people don't anticipate. There's a sense that if you have it in your house where you can touch it, you have control. Let me tell you about someone. Let's call him Marcus Boyd. Marcus is in his early 40s. He works hard, saves his money, and early in 2026, the economic news finally gets to him. He takes $50,000 and puts it entirely into physical gold coins. He wants to feel secure. What Marcus doesn't quite see is what happens next. He has to buy a safe. He hides it in his closet. Every time the market dips, he checks the price on his phone. His money, which was supposed to protect him, has quietly become a source of daily anxiety. Now let's look at someone named Karen Ellis. Karen takes her $50,000 and quietly places it into a broad market index fund. She doesn't buy a safe. While Marcus is checking spot prices at 3 in the morning, Karen is sleeping. The companies in her index fund are selling products, innovating and quietly compounding through corporate earnings. 5 years later, the panic subsides. Marcus still has his coins worth roughly what he paid. Karen's money was actually working. That's not a rule, that's just what I noticed when I looked at who was actually building wealth versus who was just trying not to lose it. If this kind of calm, long-term thinking is useful to you, the slow, honest kind, the subscribe button is right there. It's the only way this channel keeps going, and I'll be here every week working through exactly this kind of thing. Now let's look at the hidden math. This one hides better than the daily price swings. Because none of the friction is visible when you're caught up in the buying frenzy, there's an assumption that if the news says gold is at a certain price per ounce, that's what you pay, and that's what you can sell it for. Here's the quiet part most people miss. The physical metal market is built on premiums and spreads that quietly eat your capital. When you buy physical gold, you pay a premium to the dealer, sometimes 3, sometimes 8% above the spot price. When you finally decide to sell it back, they buy it from you at a discount. Individually, these percentages might not feel like a deal breaker, but collectively, they form a massive hurdle you have to clear just to not lose money. Think about what that friction actually does. It means your asset has to grow by 5 to 10% just for you to break even on the transaction. Add the cost of a secure safe or a bank deposit box and the insurance policy to protect it from theft. In a year where a simple, boring, high yield savings account or a treasury bill offers stable, stress free returns, the math on physical metal begins to look very heavy. You are paying a high recurring price for an illusion of control. This is the one that drives all the others. Because on its own, a gold coin is just a piece of metal. But when the reason you're buying it is because a headline told you the system is breaking, the psychology changes completely. Behavioral economists know that humans feel the pain of a loss roughly twice as strongly as the joy of a gain. This is wired into us. But in the context of modern finance, it becomes one of the most expensive instincts most people never consciously name. The urge to buy gold in 2026 isn't really about finance at all. It is about psychology. We buy it because we want a physical shield against an unpredictable future. None of this is wrong exactly. It's perfectly natural to want to protect what you've built. But sitting on a pile of static metal does not create resilience. True financial peace does not come from hoarding something shiny. It comes from owning assets that adapt, grow, and produce value over time. It comes from having a financial plan that you can write down on one piece of paper, put in a drawer, and not think about again for 12 months. The crowd outside the gold exchange is running a race fueled by anxiety. And the only way to stop feeling anxious is to opt out of their game entirely. So here's what I'd actually suggest doing this week. Not a drastic move, just a few quiet questions worth sitting with. For your cash, is your emergency fund sitting somewhere safe, accessible, and earning a quiet yield without you having to lock it in a physical safe? For your portfolio, is your diversification driven by a long-term plan or by a news broadcast that terrified you this morning? For your peace of mind, when was the last time you bought an asset simply because everyone around you was panicking? None of these are judgments. They're just the questions I wish someone had handed me earlier, before I confused buying out of fear with actually building wealth. Remember those two people on the street at the beginning of this video? One of them is holding a heavy asset and feels the weight of the daily news cycle every single morning. One of them holds productive assets and lets the market do quiet, unremarkable work in the background. The one with options didn't get there by predicting the end of the world. He got there by being a little slower to panic and a lot more honest about what fear was actually costing him. Safety isn't dramatic. It doesn't announce itself. It builds in the background. In the gap between what you earn and what you consistently invest in things that grow. And every decision driven by crowd panic, no matter how reasonable it felt at the time, costs you a little bit of it. Quiet doesn't mean small. If you want to keep thinking this way, subscribe and I'll see you in the next one.